Hi everyone, welcome to the first episode of Unfiltered Investments. My name is Damini and I'm very excited to finally share this project with you. The reason why I started this podcast is because most of the conversations in finance happen behind the doors. And my goal is to open these doors so that you are a part of the conversation, whether you're an investor, a young professional, or just someone who's excited to learn more about this space. We're going to dive deep into topics like private equity, hedge funds, bonds, fixed income, and all the other investment options that are out there in the market.
Before we start the podcast, we would like to thank our venue sponsor, On the Road Speciality Cafe and Bistro.
I'm very excited to have Mr. William on the board today. So he is the CEO and president of the CFA Society Emirates, and we always run into each other. He's always there, the most liveliest person you'll find. Anytime that I meet him, I'm always grilling him on questions. Oh, what's happening in the market? What's going on? What do you think? Random ass questions. And he's always there to answer. And he's been super helpful about it. So I was like, if not him, then who's the better person to have here on our podcast today? So hi, thank you so much for joining us.
Thanks to you.
Yes. So for people who don't know, you can find a video about him on the CFA Society website where he talks about his childhood and how he came here and the career progression. But we'll ask him directly. Could you please tell us how was your career like? How did you start? How did you come here? And how did it all work out?
So studied economics at university and graduated from from Paris 2 Assas, which is a good university in Paris from economics. So I graduated in economics and monetary science. My first internship was my first job. I didn't know. That was a long internship, like 9 months.
Oh, wow.
But at the end, they couldn't get rid of me because I was part of the furniture. So that was with AXA Investment Managers. I really enjoyed it. It was my first experience. This is where I discovered that you learn theory at university, but you learn practice when you join the labor force and you join a company. And I really learned a lot. I traveled a lot thanks to this first experience. And then I moved to the next, and I'm sure you'll ask me more about it later on.
Sure, yeah.
But maybe I did not address childhood or...
Yeah, so we wanted to know. So in the video, you mentioned about your childhood at Lebanon during the Civil War.
Yeah, it was challenging. It was challenging childhood. It comes with its plus and minuses, of course. The pluses being having a family to support you and you belonging to a great family and having a great education, even though sometimes your parents were wondering if they can feed you the following week or the following month, knowing that when there's a war, there's no salary, etc. So I'm the child of 2 teachers, blessed to be the child of 2.
Wow.
Tough education, of course, when you have teachers at home, both 2.
Very interesting.
And they want you to be the best in the classroom. Even if you cannot, they still want you to be the best because they always feel like, hey, what the teacher will say if you have 2 teachers at home and you still don't get good grades. So that's high pressure, lots of pressure, and it leaves its good benefits and scars also on your personality. One of them is that now if you do a mistake, I'll correct you immediately. That's a teacher's, I would say, syndrome.
Yeah.
But otherwise, I'm proud to be their child, and I hope they're proud of me today.
I am very sure.
Thank you.
So you studied in Paris, and then when did you come in the region?
When did I?
Come in the region, in the MENA region. Like
the MENA region. I didn't come before 2008, which is a great year where the crisis was unfolding in 2008. But it was a good time to meet people over coffee, tea, and because everyone told you at that time, we're not investing, so you're wasting your time. I still wanted to go and waste my time by getting to meet them, getting to talk about their future investment needs and see how we can be closer and have what we call client intimacy before later on there'll be investment opportunities for sure.
So now that you've been in the region for so long, like since I'm born and brought up here, Dubai was nothing back then, right? Like even when I went, we just had like 3 schools and one of them was okay, quality of teachers was also, they are the teachers, like it is what it is kind of a thing. But how have you seen the investment game changing? Because there wasn't a lot of investment activity happening. I think that was the time when people were building their wealth rather than now investing it. So how was that journey like and how is it different?
It's definitely exponential from what you experienced, from what I experienced. It's interesting that you mentioned schools, because schools are now in investment themes for some, which I've never seen before in Europe before coming here to the region. So I would say that in the region, the learning curve has been steep, but very fast. People learn quickly. People invite. I always say this country is business friendly because it's inviting investment ideas, capital, human capital, real capital, artificial intelligence, any capital that is helping to create the best investment, I would say, arena. So then later on, every one of us can find their way and their inspiration to be the best version of ourselves and the best version of our organizations or companies. So before coming to the region, I thought I will not benefit, I will not learn, because it looked like from far away that the Western world is bringing talents to the region, but not really learning or not really coming back to Europe or to the US or to Australia and to other Asian countries with a know-how. But this has changed dramatically and drastically throughout the 18 years I spent here.
Yeah, I'm sure. So in terms of types of investments, the two most common that people know about are equities and bonds. So if you were to differentiate them in the most simplest manner, how would you do it?
I like to keep it simple. Equities, you own a share of a company. So if tomorrow you want to earn a share of NVIDIA or any other Meta or any other company, by buying the stock, by buying the equity, you become an equity shareholder. So you're buying a fraction of the capital of that company. So you become an associate in a way, or a partner with other stakeholders, or shareholders across the globe of the same stock. If you buy a bond, then you're lending money to that company. What's the difference? I always like to talk about risks. I always like to talk about worst case scenario. In a worst case scenario, you as a bondholder, all you're getting is a coupon, which is kind of an interest rate that you earn on the money you lended to this company. You hope that they will always be in a good financial situation to give you back your money, which is the value or the face value of that bond. You lended them 100. They gave you $2, I would say, every year for the next 10 years. You're hoping to earn these $2 every year and the $100 back at the end of the 10th year. That's what you're a bondholder. An equity investor will be buying a share, hoping to get dividends. We never know. It depends on how much money they will make, how much earnings, how much profits they will make, and how much they decide to distribute back to you as an investor. They might hold these earnings and profits and reinvest them in the company because they need to grow exponentially and they need that money. This will be reflected in the valuation of that stocks because it's listed on the stock exchange. In case of major risk, in case of problems with the company, if they call, if they fail as an investment idea or a company, if they go bankrupt. In case of bankruptcy, you as a bondholder, you will be first served with whatever is left. It's very important to understand. You're not going to get the 100 back that you invested. You're going to get whatever is left in the company after selling the assets, after going through long lawsuits. But you'll be priority to get some money back. Normally they call it cents on a dollar. So from your 100, if you get 50 cents on a dollar, you're going to get back $50 and you lost the other 50. As an equity investor, you're last to be served. So the bondholders are served first. That's why we call the bonds safer than equities. That's in a very simple way.
So just like out of curiosity, why are bonds not as accessible as equities are? So there are a lot of platforms where you can just buy and sell shares, right?
True.
But in terms of bonds, I don't see that accessibility. And is that maybe why a lot of people don't even know about it or find it complicated?
I would say, first of all, from a pricing point of view, the minimum ticket to buy a stock, if the stock is $100, you can put $100 and buy one share of that company. Unfortunately for bonds, the tickets tend to be higher, at least $200,000, $300,000. If not, some bonds are trading on $500,000, $1 million. So first of all, there's a barrier to access, which is the cost or the price. Second, it's more sophisticated to work with bonds. It needs more mathematics to understand the duration, the convexity. Without complicating the conversation, you just need to understand by how much your bond will go down if interest rates go up, which we call the duration risk, and vice versa, by how much your bond will go up if interest rates go down. Because you're always comparing what you're earning to this bond. You're comparing what you're earning on that bond to what is being given on a short-term deposit in the bank, right?
Yeah,
if the short deposit in the bank goes to 10% and you're having 5% on that bond, people will try to sell this bond to go and get the 10%. What's going to happen with something you're selling excessively? The value will go down. Now, if your bond is giving you 10%, or let's say at 5, your bond is giving you 5% coupon per year, and interest rates in the market go to zero, like there was the case 15 years ago. People want this bond that you're holding because it's remunerating more than short-term deposits in the bank. So people fly to this bond, buy it, overbuy it. What's going to happen to the value of something you're overbuying? It goes up. So here where you understand the duration risk. There's also another risk called convexity risk, liquidity risk, and other risks. So in the bond system or in the bond valuations, you have more mathematics involved. That's why maybe some people find them a bit more boring or less accessible, and they like a little bit of more luck with the equities.
True. So in terms of, since you deal with more institutional investors rather than retail investors, how do institutional investors think about bonds and equities?
So definitely institutional investors start with their own liabilities or with their own long-term and short-term and mid-term objectives. And based on that, they will reverse and engineer a portfolio that serves those needs.
Okay.
Think about a pension fund. They have liabilities. Liabilities are to pay pensions for people who reach the retirement age. This is a liability, and they have a population of different age. So they're gonna do liability-driven investments, and based on that, they will shape a portfolio that serves this cause using equities and fixed income. Fixed income will be a buffer in case of major crises. It will, thanks to the negative correlation between the two asset classes, not all the time, but normally they're supposed to be negatively correlated. This will help you to diversify the portfolio, and not both parts of the portfolio should go down when interest rates go up, and vice versa, go up when interest rates go down. So the diversification will give you this risk lowering and optimization of returns thanks to the combination of two asset classes. You rarely see an institutional investor telling you, I want only equities or I want only fixed income, unless they really super underfunded, which means they don't have enough money to serve the retirees' pensions. They'll be super underfunded, and mainly they will rely on fixed income or bonds and bonds-like investments to serve those. But you rarely find an institutional investor not holding both asset classes in different proportions with different, I would say, mandates to serve different future objectives, but also future liabilities.
True. That makes sense. So in terms of coming into asset classes, we have equities, we have bonds. The other liquid investments is REITs. So if you could just explain us what are REITs.
So real estate investment trusts. It's an investment vehicle that will help you. Most of the time, it's a company that will help you get access to a portfolio of real estate. Again, like with the bonds, you are giving them your capital and hoping you will get yield on that capital. Where does the yield come from? The yield is coming from this portfolio of real estate holdings. It can be commercial, it can be residential, a mix of both. So commercial is like for offices. Residential is where we all live and pay a rent. All these rents come into the forms of yields for you as an investor. So most people cannot buy hundreds of buildings and rent them out, manage those on a daily basis, and get the yield out of those in terms of rents. Ideally, you want to invest in a REIT that is listed and that is giving you every year a certain return that is derived, or that is, it's derived from all these rents minus their management fees.
So when someone is calculating in terms of the returns, when in anything, right, let's say equities, bonds, or REITs, in terms of fees, I know since you talk a lot about fees, could you tell us what are some of the mistakes that investors make and they should be careful of?
So first of all, as a disclaimer, I'm not against fees. When you go to see your doctor, you don't question why you're paying X amount of dirhams to access the doctor service, right? They studied long years. They have long years of experience. They're helping you to extend your life. For this, they should be remunerated. Not exaggerated remuneration, but a certain decent remuneration. So then they keep doing what they're doing and you keep benefiting from their services. Same thing goes for the financial industry. There should be fees. So then the financial industry can still serve your wealth.
True.
Doctors serve your health. Managers, investment managers serve your wealth. So we want to make sure that they are compensated to really work with you for the long term to achieve your investment goals. When is it too much? When is it too little? I don't think there is too little, but there is too much. There are too much fees in some cases where actually you look at beautiful returns upfront and then what you get transferred to your bank account is so little. So this is where you should question why all these fees are being levied. What is each and every fee is doing towards my financial goals? So it's very important to always judge the fees and always ask for the fees before you go ahead and invest. So you mentioned REITs, you mentioned bonds, you mentioned equities. If these are managed in a portfolio where it's maximizing your returns, reducing your risks, and getting you a risk-adjusted high return, then you want to encourage that portfolio manager to do more and to not more risk, but to do more risk-adjusted returns for yourself and for your portfolio. And you want them to maximize this ratio. So you apply it to all investments. Ask about the fees, ask about the hidden fees, ask about the performance fees. Because sometimes you do great performance, but then some of it will go to the portfolio manager because in the documents in the beginning, they made you sign where not only they take management fees because they're managing your assets, they take performance fees. Also ask how come if the portfolio is underperforming, portfolio manager, you keep on rewarding them. Because if your doctor is not performing, you will change them to another doctor, right?
Correct,
So I like the analogy with wealth and health. Look at the fees, make sure it's coming to compensate hard work. And hard work for me means high risk adjusted returns.
So when you deal with investors, right, how do you build trust with them? Because I think there's so many investment managers out here who are trying to pitch in the products or the kind of investments they do, but you need to make sure that you're picking the right one.
True.
So if you're building a trust or a relationship, how would you do that?
So first of all, eliminate bad advisors. Bad advisors don't have time for you. Bad advisors talk about products. They call you only when they have a hot topic, a hot product. Rarely when they have time to understand with you what's happening globally, to update you on matters that you don't understand, because you're not all economists and investment managers and financial advisors. There's a book I recommend. It's called The Trusted Advisor. It's available everywhere. It's not expensive and it's an easy read. It's not complicated. And it tackles simple things. And I'll leave you just with the formula that is the essence of the book, which is the trust equation. It's very simply on the top of the equation or the ratio. On top, it's their interest, so your client's interest. As an advisor, you look at your client's interest and you divide it by your interest. No need to be a mathematician. You want to make the numerator go up and the denominator go down. You want an advisor that puts your self-interest top of their mind, on the top of their minds, and their self-interest low in their minds. What does it mean? Transparency, honesty, telling you things, even if they're ugly, they should tell you how an investment is made. When things go bad, they should be next to you, hold your hand, because you might sell when it's low and buy when it's high. To buy when it's high, you don't need an advisor, you do it on your own, but the advisor is there to slow you down and say, if everyone is rushing to gold today, maybe we're a bit late in the race and it should have been a diversification exercise 2 years ago. If bonds are very pricey today, maybe you should have started 3 years ago when interest rates were very, very high, but still the prices of the bonds were interesting. If you're going into equities and now the valuations are to the roof, also you should be careful because maybe you're buying too high. Now, when things are sour, where bonds are down, and then when equities are down, and then when gold was down a few years back, you should have been buying.
Yeah, true.
Silver was down a few years back, and people run away instead of buying it. So it applies to all asset classes, including REITs,
Yeah, true.
if they go down, and if the portfolio within that real estate investment trust is a worthy one, is yielding, a high yield one with less risks, you should be considering asset classes when they are cheap. And a good financial advisor will put your own interest first and will not be just selling you the hot topic because their bank asked them to have a competition and the best producer will travel to the Maldives to enjoy some holidays. They should put your interest first. And knowing that you are a low-risk investor, they should not come to you with high-risk solutions and vice versa.
So as an investor tomorrow, if I was to choose the right partner for me, how would I do that? What are some of the things that I can look for in a person when I am choosing one?
Highly educated, but highly experienced.
Okay.
They go together.
Okay.
Some people have lots of experience, but they educated themselves along the way. I have no problem with that.
Yeah.
But long experience.
Oh.
And being referred and recommended by other clients.
Yeah, true.
This is the best.
Word of mouth works.
Without them knowing, you can reach out to some people who work with them and ask them, what do you think about XYZ? Ethical is number one. Yeah. So experience will give them intelligence, but also ethics will hold this intelligence from becoming a force for bad instead of being a force for good. Who's the best investor in the world? Isn't it Warren Buffett? He keeps on saying, I don't want to hire the most intelligent people or the smartest in the room. I want to hire smart and ethical people. So it's a good combination of being smart and ethical instead of being the smartest. Smartest and fastest can take your money quickly away.
True.
So this is the major quality. You want them to be experienced. You want them to have time for you, not to manage. Experience says that more than 200 clients, it's difficult to do your job as a trusted advisor, because if you want to just meet them an hour per year, that's already 200 hours of work gone. If you want to meet them twice, that's 400 hours. You want to prepare for those meetings, more hours gone. If you want to follow up after the meeting, more hours gone. So 200 clients per financial advisor, that's a magic number. You want them also to be well remunerated. We mentioned this earlier. So if they are giving you good advice, you should also pay for that good advice, because it's giving you more, again, risk-adjusted returns. So you have more money flowing your way. So they should be also compensated for that.
True. So with AI coming up, right, do you think that AI can replace these wealth managers to some extent, if not a lot?
Not yet. And I'm hoping to be right for long term. Otherwise, our industry will face really a wake-up call that's harsh to digest in terms of layoffs and less opportunities for the young generation. I'm more like a rational optimist when I speak about a combination of artificial intelligence and human intelligence.
Yeah, true.
So combined together. As a financial advisor, I just mentioned to you, for financial advisors, they have 200 clients maximum to manage.
True.
But the face-to-face part, no one can replace it yet.
Yeah, true. I agree.
So let's say more back office, mid office work will be prepared thanks to AI. More checks and balances will be done by AI. More, I would say, repetitive tasks will be done. Like your reporting can be now done in a few seconds. Managing investment trends, looking at what's happening around the globe. These all like Outlook reports. The other day I sat down with someone who's developing in Abu Dhabi a great AI tool for seeing future earnings, but also future data on governments.
Oh, wow. Okay.
So while sitting with you, I can tell you that we expect actually inflation to slow down or not to slow down in that geography. That's the GDP outlook. And so those data that used to be uncertain, unknown, now are almost fine-tuned thanks to algorithm instantly. So my conversation will be with you as an advisor, will be a smarter conversation, will be a better prepared, better equipped conversation. So then I can spend more time with you discussing what keeps you up at night, how you want to send the kids to school or to university later on, that major project you wanted to develop and have your own house and your own hobbies coming to life. Those early retirement plans, how can I help you materialize those? because as much as life is extending thanks to life science, we really want to spend more time with loved ones and we want to exercise our hobbies. So I think AI, and I believe AI is going to help us reach those personal goals and professional goals faster in a more scientific way. So then there is less margin for error and more, I would say, service done to clients. So again, remember what I said earlier, still reward your active trusted financial advisor, because they're spending quality time with you and helping you optimize your goals while reducing your risks.
So the other question that I have is in terms of investing, right? If I am investing, do you think I am better off doing a passive investment or an active investment?
I've always worked in the active space, so I might be a little bit biased, but some geographies today, and based on institutional investors, some geographies and some markets are so over-invested that going passive is actually increasing your risks.
True.
And definitely you should be doing active management. So there's a contradiction. People told us in the developed world, you should go passive because the market doesn't have any inefficiencies anymore. Well, thanks to index investing, people passively throw the money on indexes, thinking the index is an absolute representation of the full market, which is not the case. And you know very well that. So I'm a big believer in active management, and this is why it justifies a fee. If you're using just computer-based investing to go into indexes, the fee will be minimal. And there's no story around that and no storytelling around this. Now, active management is going and betting on all these profitable companies and sometimes boring profitable companies that for the long run will make your alpha within the portfolio. So I think before comparing passive to active, we should ask ourselves, do we want to blindly jump in a vehicle that mimics the market? Not the whole market, a big chunk of the big major actors in the market, or we want to be more nimble, give our money to a portfolio manager and an analyst and an AI tool that spend all their existence trying to find the truth about companies, avoid the losers. There's a big performance coming from avoiding the losers and investing in the performing, profitable companies. Earlier we spoke about why do I buy a share in a company or a stock? Because I want dividends. Dividends come from earnings, from profits. If a company is not making profits, why on earth are you
investing into
jumping and running and following the herd into an index? Sometimes most of those companies you're going to and investing in will not give you the dividend you expected. So again, put your money first, put your interest first before following the herd and jumping on an index. If the story here is to buy cheap, then you're not made for investments, because most of the cheap investments will get cheaper. So you buy the index because it's cheap management fee, right? By buying cheap, you might be buying risky. So just make sure what's inside the wrapping paper of a gift is. Sometimes you grab something in the supermarket because it's cheap, it's on discount. Once you arrive home, you realize it was not made for you and it's money you've lost, especially when it says you cannot return it back. And same with stocks and bonds. It's written, you cannot return them. You can try to sell them back to someone else who believes they're gonna appreciate. But again, indexing is good if the world is perfect, and we know that the world is not perfect, and there are still investment theses being written about the top performers of a benchmark and the other companies that can help you benefit and beat the benchmark.
So in terms of alpha, how much percentage alpha do you think someone should expect in terms of making these investments, right? When you are rating a manager, right? Or when you're doing their check, you're doing a performance check on them. How much alpha do you think is something that someone should expect?
I don't think I understood the question.
So the question is, like, let's say if I am investing with a manager, right? And they're telling me that this is how much percentage of alpha they're giving me. What number is correct in terms of something that is reasonable versus a number that doesn't make sense at all?
It honestly depends on the asset class, on the sector, on the geography. In some markets that are very inefficient, I would say like frontier markets, alpha can be double digits sometimes.
Wow, okay.
So I've seen that, especially in the MENA region, in the early days of the MENA region.
True.
Maybe the benchmarks were also very recent and very young. So some managers really did lots of fundamental research and were beating the benchmark by a high single-digit alpha. So later on, more investors came to the market, and there's more competition, and of course, you will not expect the same alpha generation capabilities. Now you go to very developed countries, that your alpha will be smaller, and there'll be more people researching the market and competing to get a share of that alpha. Again, alpha is measuring the skill of your portfolio manager to beat the market represented by a benchmark.
Perfect. So when it comes to investors that you deal with, the institutional investors that we spoke about, a few that I know of are either pension funds, family offices, and sovereign wealth funds that are a very big part in the region. If you could just tell me, how are they different from each other?
So let's start with the biggest. A sovereign wealth fund is a fund that belongs to the state and that will serve future generational needs. So it's not for this generation, it's for the future generation need, or the future generations need. It's served in a way, it's managed, in a way to maximize the profits or the returns at the lowest risk possible. So it's definitely a risk-adjusted return, maximizing a risk-adjusted return, I would say, purpose. If we move to the pension funds, they have liabilities to serve. So they take the population age, they calculate that they are working, and after a certain amount of years, they will retire, and they can claim a certain percentage of their last salary. Some economies are very generous and give you a high percentage, others a lower percentage, but they also invite you to have your own savings, to have your own investments into a private pension fund. But a public pension fund is definitely projecting the future needs of the population in terms of retirement earnings and revenues, and are investing today to service those future needs. Some of them do not invest too much and do, like in Europe, some of them do distribution. So they take from the young generation and give to the older generation to retire. Others do invest for the long term to service those needs. A family office is, as it mentions, a family who became super institutional in a way that they need their money to be managed in an institutional way. Now, of course, they can go to see in a bank or an investment management company to do those on their behalf, or they set themselves up to at least select the best investment solutions for themselves, or in some cases, manage money also actively themselves. So you have, as much as for sovereign wealth funds, you have different ways to do so. For pension funds, you have different ways to invest. Also for family offices today, you have different levels of sophistication within the family office space.
Right. So just to break it down in terms of the portfolio mixes that look like, right? How is it for a sovereign wealth fund versus a pension fund versus a family office?
Again, there's lots and lots of diversity here, but in general, the sovereign wealth funds are organized by big pockets of asset classes. Sometimes in the same asset class, they have different sub-asset classes. They tend to look at a core portfolio plus satellite investments to maximize the earnings. Core means 80% of your investments, plus or minus 80% of your investments are going into a core portfolio that's serving the future objectives of maximizing profits and minimizing risks. But you also have the liquid part, the less liquid part, you have the direct investments part within sovereign wealth funds. So I think it's very diverse and very global in terms of approach. Pension funds, I don't want to generalize again, because we do lots of mistakes when you say generalities. But the pension funds, since they have liability-driven investments, will look at the fact if they are overfunded, funded, or underfunded. If they're underfunded or barely funded, they will take a lower risk portfolio. And they want to make sure they will be reaching that target future return with a lower risk. So what they do liability-driven investments. If they are overfunded, they have a portion of the portfolio that can be a little bit more risk taking to maximize returns. And the other part of the portfolio will be really serving the minimum needs of the future retirees. Now, the family offices can be more exotic, can be more innovative, can participate in smaller deals, I would say, where actually lots of GPs look for them because they wanted a smaller, I would say, pool of assets, and they really want to target like-minded investors who can be moving fast, but also can hold longer the course of actions, whereas a sovereign wealth fund will ask to be co-investor, or they want to deploy a few $1 billion, and if your fund is already like $1 billion to $2 billion, it's too small for them.
Yeah, true.
So sometimes size is an advantage or a problem depending on deploying capital to harvest future returns.
So I'm just going to break it down in sections, starting with pension funds. What do you think about pension fund as a whole in MENA region? Like, do you think that people are at a point where they do think about money in the future when they're older? Are they saving or are they investing? What does that look like here?
So we're talking about a very wealthy part of the world,
True.
the GCC countries, Gulf Cooperation Council. All these countries have rich and healthy pension funds, public pension funds.
Okay.
But let's not forget that the public, healthy and wealthy pension funds are here to serve the retirement of the local population.
Okay. Fair.
And the local population can be well enough with those pension funds. As of today, and I think for the next 10 to 20 years, we don't need to worry at all about these funds, pension funds. Again, you need to go and do your own due diligence as a citizen of those GCC countries and check if there'll be enough retirement paid for future generations. The expats living in those economies, I don't think realize the risk they're taking.
Mm-hmm.
So mainly they came to this part of the world because of a job opportunity, of a salary that is better from other places with less income tax or no income tax at all.
True.
So this is appealing. But with that extra income comes extra responsibility. What if one day you have to go back to your original country and you didn't save there for retirement and here for retirement? What if you lived all your life not saving and comes retirement and you can't work like before, you're not productive like before, job opportunities don't fly to you as often as they used to do before because you're just aging, and it's a real thing in life, aging and not being able to work anymore. So this is where you need your savings. This is where you need a health system that will support you. This is where you need a pension fund that will support you. If you don't have an answer for these things, you should run immediately and put some saving rules into your salary. Of course, check fees, check which asset classes, but definitely put a mandatory rule to save. Some economies force you to save because they know that aging is a process that's happening while we don't look at it, we don't think about it, and then it's sudden. It happens slowly, and then it suddenly hits you.
Yeah, true.
And you're out of job and you cannot find a new job. So better to save early than you save less and you have a lot when you retire. If you start late, better to put a big chunk, diversify it in terms of risk, and make sure you give it to the hands of people who are honest and really want to maximize your returns with the lowest risk possible, because we all deserve to retire in a decent way with decent enough of money to pay for healthcare, to pay for medication, and to enjoy some traveling.
Yeah, true, fair enough. Now, coming into family offices, has there been a situation where a family all of a sudden has like a big exit and now they have a chunk of money at their disposal and they want to start like an investment arm where they start investing and build that portion of their wealth? And if they're just starting out, they're very new to this world, how do you deal with them? Because I'm sure they don't know about what investments are happening in the market, or, they have certain misconceptions when they come into the industry and they find out it's a whole different thing. And also, since they are biased, by people making their own personal investments. They're like, oh, my friend made this much, so why would I give you this much? And it doesn't make sense. So does that happen very often? And if it does, how do you deal with it?
So first of all, let's say that investments have nothing to do with fashion.
Yeah.
And this will save you lots of money and lots of losses. So if your neighbor is dressed in a nice brand, it doesn't mean that your brand is bad. It means that you're comfortable dressed this way and you should carry on. You don't waste your money trying to look like your neighbor.
Yeah.
That's from fashion point of view. From an investment point of view, it's exactly the same. Your portfolio should serve a future liability or a future investment goal or investment goals. You reverse engineer this to today and see how much you should diversify into how many asset classes. What's the timing of buying these asset classes? If they are expensive, it's not the right timing. Did you hire the right experts, the consultants to help you build that? So what I've seen is that, yes, there are families who are blessed to receive a big amount of capital to manage, and they realize immediately it's no longer enough to be using a banker or a financial advisor, and all of a sudden they need to have their own investment committee, their own chief investment officer, their own PMs, and the portfolio managers and their own analysts. Doesn't happen overnight. There's also a legal structure that they should worry about and fix. How, as an institutional investor now, they take decisions, they do due diligence, they select managers. AI can help you a lot in manager selection, and consultants will help you definitely in manager selection. The data is there. All you need is to spend the right time selecting the best to service the best asset classes within the best mix into the best portfolio.
Got it.
So again, a total portfolio approach given to the hands of experts because they spend years of being successful with other family offices, and then, or institutional investors. I've seen lots of influx from sovereign wealth funds, pension funds, towards the family office space, because these are very expert people trying to get a decent way of living, and they found that it's better served within the family offices. Some family offices are so inspiring that they attracted big talents from big firms.
Yeah, true. So then here comes, I heard this in an interview where this guy had a startup, and once they did get their funding, they hired people from the biggest of companies. But what they didn't realize was that their startup was at a different size versus that company being at a different size. They're used to making decisions on a bigger scale rather than then coming into a family office and then making decisions on a smaller scale, right? So do you think that way families are hiring the right people? And if there is a gap?
I'm hoping they're hiring the right people. I leave it for them to assess that you've been playing in an ocean and now we ask you to play in a lake.
Yeah, true.
And do you realize not just the different needs? Again, it goes back to what I said earlier. A trusted advisor is someone who puts their client's interest first.
Yeah.
So are they putting, because your employer is actually your client when you're a family office. So are you putting your employer/client interest first? Are you educating yourself enough about the portfolio? What are the future goals? What are the risks in terms of liquidity, in terms of the inherent or the intrinsic risks of each asset class? Before you were part of an army managing the sovereign wealth fund. Today you're on your own with maybe one analyst dedicated to you, but to other colleagues. And you're on your own doing all of that. So are you spending enough time to educate yourself, to work in a sophisticated asset allocation exercise, being helped by yourselves, colleague consultants, and also some data that's available around you that will help you to sharpen your decision-making process.
True. And then coming into sovereign wealth funds, when they look into AI, are they looking at it just as a tool or as an investment thesis as well? And how do you see them approaching the AI industry altogether?
Based on recent announcements this year and last year, it's definitely an investment tool. They will less talk about it, but definitely they're using it as an investment tool, as a quantitative investment tool. It helps, as I mentioned earlier. It's a great assistant when you're selecting managers, when you're selecting investments, but they're also investing in the AI space. And our region is blessed to have lots of energy and lots of space. And this is what you need for data centers. And this is what you need for AI. So the region is gearing itself up to have an edge within AI as an investor, but also as a major consumer of AI, to improve the productivity of the nation, to improve the profitability of the nation, and to be, again, as I mentioned earlier, a business-friendly area where people come, build their investment ideas, companies, and thrive and export to the world.
Yeah. The other question that I would have is more on, not on the AI side, but relationship building side. We see a lot more people coming here to do fundraising, right? A lot more funds or asset managers now targeting MENA region as the next big thing, right? What are some of the mistakes that they're making and they don't know about what's happening in the region?
So the major mistake is to fly in, fly out. The major mistake is to consider the GCC as a place where you come, take money, and go and invest it somewhere else. The smart, trusted advisors are the ones who come on the ground, sit here, get familiar with the GCC region, with the mentalities, with the specific needs of this part of the world, and take enough time to digest and understand that it's a co-investing approach. Not all the time you have projects that you can offer investors in the region to be co-investors, but there are always opportunities where you can share knowledge, train the young talents at those GCC investors' premises, help them grow with you if you really care about them and you're a trusted advisor. So I've seen definitely the ones who come to snap a deal and run, being short-lived and being really short-term investments and relationships. And I've seen people really investing in the long run by creating partnerships here on the ground, respecting the culture, understanding the culture, investing in the culture, investing in in young talents, but also seasoned ones, and creating partnerships on the ground. So I've been hearing the word partnership for the last 10 years. Before, it never existed. It was fly in, fly out. It was an export model where you export your capital to be invested elsewhere. Now I hear the word import-export model, where we want you to invest in the region and we want to invest also in other regions in the world. And this is very beneficial. This is where the competitive edge will play. If you have a great idea in the US, you will invest in the US. But if you have a greater idea in UAE or in Saudi Arabia, you will definitely invest in that greater idea here in the region and save yourself some opportunity cost that you should not be taking.
True. Then that comes to my next question. Are the decisions still made very relationship based, or are families and investors now actually doing a lot of their own systems based research?
I would say the relationship will get you the meeting. The relationship will get you the right people around the table. The relationship will not force someone to invest in a lousy investment case or in a lousy investment. So otherwise the relationship will be destroyed, right?
Yeah, true.
So it's a long-term marathon. It's not a sprint. People who consider it as a sprint will fail. People who have enough lungs and enough muscles to run the marathon will be the ones who will profit from it. So the relationship is making sure the venue is there, making sure the right people are there, making sure you have a quick access to the right decision makers. At the end of the day, it's a scientific final decision making. If it's not, then you will be adding risks to your investments, and this is the least you want to do as a smart investor.
True. So this gets me to my other question. When I saw your video that is there on the CFA Institute, you talk about this incident that happened at the Majlis. Now, I have not really been in a place where there are meetings done in the Majlis. I just want to know, how did you end up there? How was your experience? Does that Majlis meeting still happen?
It's definitely still happening.
Okay.
Does it always lead to investment decisions? Not sure. Do you still have people around the Majlis asking for time to get introduced or to introduce some investment ideas? For sure.
Yeah.
But most of the time, it's a very social blessing, I would say, to get the relationships, to get closer to the relationship, to the decision makers, sorry, to get really into the partnership, I would say.
True.
But the partnership relies on you bringing your best investment ideas, your best investment solutions, and you staying the course of the investment. We know that investments go into cycles.
Yeah.
They're gonna watch you on the upside, but they're gonna also watch you mostly on the downside.
Yeah.
And they want to see in those troughs, not peaks, but those troughs, how you behave and how you help them keep the course of those investments. So a majlis, I think, is a place where trust has to be established. Once the trust is established, it belongs to you to keep the trust and the relationship live. If you're a short-termist person, you will not get reinvited. But if you're long-term, strategic thinker, someone who shares bright ideas, bright innovations, who gets the luxury of being part, I would say, of the family or the friendship of that decision maker, then you're definitely reinvited and you will enjoy the perks of that majlis.
Now, the next thing would be decision making, right? Do you think that the decision making is happening in the right manner and the process is staying? Like, you talk a lot about governance, right? Do you think that is being followed here?
Depends of where and to which extent. So we are humans, we're not perfect. Sometimes you still have, and I've seen it happening in the past, not at any firm that I worked at, but at a client's firm, where someone was complaining that they've been forced to accept an investment and they felt like their job will be at risk if they don't do so. I think it happens at a smaller scale in smaller organizations. At a big state level organizations, the decision-making process is very sophisticated. It goes through different layers and different committees. So, and here also AI will help you.
Yeah.
Because you'll be saying, okay, you want us to go this direction, but all the scientific data coming from AI is telling us not to go into this direction.
Yeah.
So maybe AI is here to help you save your job, save your decision-making process, and stand up a little bit towards reminding institutional investors that this is the best, in their own best interest, to follow a scientific approach rather than one where the investment committee can have some say around, oh, we know these people, they're closer to our decision-making process people, and we should think about the relationship and how to maintain it. If you don't invest in them, they'll be disappointed maybe. So, oh, we have some common investments with them somewhere else in the world. We want to manage this relationship holistically. All these words I've heard in the past coming from the mouths of people who are disappointed by their organizations and people who are willing to leave those organizations because they don't feel comfortable anymore to take decisions that are not scientific as much as they are more relationship driven. So all of us want to work in an environment where it's more scientific decision driven process than, I would say, biased towards some relationships.
Okay. So then the next thing is Islamic financing or Islamic investing. I've heard a lot about Sukuks and things like that. If you could just explain a little bit more about it.
Islamic finance is faith-based investment, right? It's following a certain framework where you're not supposed to harm nature, harm human beings, and make money on money, which is a bit ugly to think about. But if there's no real commercial activity behind it or real economic activity behind it, how come you're making money on money?
Yeah.
So I like those principles. I wrote in the past a small text on bringing and bridging the gap between ESG or sustainability and Islamic finance. And I think the bridge is there. It might not be perfect, but also ESG started with belief-based or faith-based beliefs, right? Investments. It's Judeo-Christianity that came up with ESG, and if you go back in history, and Islam came with Sharia investing. So the framework is very healthy to follow. Sometimes you might bump into some technicalities and you have scholars who will fix it for you. So in a way where the religion will benefit from those fruits of investments, but also you as an investor don't find yourself in front of any obstacle when it comes to Sharia investing. We have a huge portion of the global population who is willing to invest through Sharia beliefs. Again, you always hear me talking about be careful of what is not Sharia and being labeled as Sharia. Be careful of what is not ESG and labeled as ESG. So what I'm trying to say today is sustainability and Sharia are very close to saving nature, saving human rights, and really saving the society in which we work and thrive. You don't want to be working for an employer that doesn't respect you as a human being. I don't want to be working for an employer that pollutes the river and the ocean that I'm drinking the water and swimming in. And we don't want to see the icebergs melting, and this will create a big problem across the globe. We don't want to need to leave our countries because they're overboiling with the global warming. So it's a great cause. It's not a great marketing tool. So I would run away from marketing tools that are using Sharia investing and are using ESG and sustainability. I would hug all these active investors, because once you say I'm Sharia compliant or I'm ESG compliant or sustainability compliant, you're active.
Okay.
You cannot be passive. You cannot buy the benchmark and sleep. Even if the benchmark says it's Sharia or it's ESG friendly or sustainability friendly. You are an active manager. You're meeting the companies. You're visiting their workspace. You're going and interviewing their employees, making sure they are happy to work for this employer. Best talks are done with employees separately without spotlights. They'll tell you lots of stories. So you want to make sure that people who commit to sustainability are the ones that you're actively selecting and adding to your portfolio. This is where you will be saving the planet and yourself and your society.
True. Yeah. So this brings me to the volunteering and the social work that you've done. I came across this society called Tohmé in Bahrain. I know that you're very big on financial literacy, and you started this as a way to provide, financial literacy to students. If you could just speak a little bit more, how was the journey? What made you start it? And, how it
So
went
Tohmé is a great initiative. That I don't want to get the sole ownership. I started it when I was a board member at Civil Society Bahrain with lots of smart volunteers. So I give credit to them. But it was my idea at the beginning to find something, to brainstorm and find a solution for unemployment for young talents, no matter where they come, which university or what field they want to be specialized in. So as you mentioned, there's 6 months of not just financial literacy, but also soft skills literacy. So we invested for 6 months into training those young talents coming from any field, any university in Bahrain, any nationality, any color of the skin, any religion. We'd never, ever discriminated in any way. So we're putting our work where our mouth is. So we wanted them to be skilled, soft skilled, but also technical skills in finance. And we wanted a commitment from the stakeholders we know in Bahrain to get them employed for 6 months at least. This means that it's a paid internship. It's made for you to get used to the workspace. And it's a little bit what I experienced myself. I started with an internship. It guided me to it yielded my first job. So this is how we started. Now it's a state-of-the-art organization under CFSIT Bahrain, run by very bright people who used to be one of the first volunteers in that group. Again, it reminds me, it doesn't matter who starts, it matters who keeps this great investment in human capital alive. So today I'm very proud to see that Tohmé is part of the economic fabric in Bahrain. It helps young talents come from university, any field, get a first experience with soft skills, hard skills like technical skills, and then go into a 6 months of real life employment and hopefully solve that kind of unemployment for young talents.
I think soft skill is something that people don't really tend to teach. Then CFS Society. I've been super involved with the society. You've also been there for very long, but I noticed that students come, they do the exam, but they don't really, then become a part of the society or meet people or network. Could you tell why it is very important and they should consider this?
So what I like about the exam is that it's a tough one, but it stops there.
Yeah.
What I like about the curriculum is that it has ethics as central part of it. So remember what I mentioned about Warren Buffett. He wants smart and ethical people. He doesn't want the smartest and the fastest to work for him, because he doesn't want his company to be on the front page of the newspaper for the wrong reasons. So here is the same. What I like about the curriculum is that it puts ethics first and foremost. But it's like everything in life. If you don't exercise, you lose that knowledge, you lose that muscle. The best way to stay fit in finance is to join a local society.
True.
This is where you benefit from other volunteers' work. This is why you have a society, because somebody worked originally as a volunteer to create the society, to put the bylaws, to put all the activities together, to create the seats and the volunteering opportunities. And myself, I benefited from that when I was in Bahrain. I joined as a volunteer, and later on I was a board member, and then comes Mutamahan, comes lots of initiatives. Came to UAE, I felt like it's like the gym, you know. You come to a new geography, you want to go to the gym in that new geography. That's why you have gyms in every hotel. You'd go and join the society. So I think I would like people to think about the society as your local gym. You stay fit because you go there, you benefit from previous experiences, you meet new people, you increase your network. And you heard me saying network is net worth. You build your career thanks to a great network. That's why young talents are thirsty for a network, and society will give them that network. And it's, for me, a way of giving back to the society. I benefited from different societies I joined: CFA Society France, CFA Society Bahrain, and now CFA Society Emirates. So the society is where like-minded people come together. They might be not like-minded, but at least they went through the same tough exam. They abided by the strongest ethics standards that exist in the industry. And they are telling you, I want to be ethical for longer. I want to be also profitable while being ethical for longer. And I want to help you and others be part of that beautiful network and help each other. Without the society, I wouldn't have the opportunity to be in front of you today. So I thank you for this, and I thank the society for helping me. And today, as a president of the CFA Society Emirates, I feel I'm responsible of a lot of legacy that goes back 20 years. And I really want the society to continue giving back to the wider ecosystem of the United Arab Emirates. So we're super accountable for generations to come. So I want people to find their job thanks to the society. I want the people to be able to change to a better job thanks to the society. I want people to learn financial matters thanks to the society, which we are doing today with the podcast. I want people to come up with initiatives that will solve future problems we might have in our economy. We cannot be always exponentially growing. There'll be maturity years where we'll need things like Mutamahan, where we help young talents to find their job. So ethics, we need to train ourselves. We need to keep this muscle in our brain working all together all the time and keep it alive. I learned something that's horrible. With aging, we lose muscles. So with aging, we need to train more. And same thing, with aging, we lose some facts in our memory. We need to keep our memory alive. We need to learn more stuff. Now AI is coming. We need to adapt. We need to learn in order to survive.
True.
I like a study that came from the CFA Institute in 2019 about the T-shaped skills. So the trunk of the T letter is what you specialize in, what I specialize in, what they specialized in. And the top of the T is really all these new skills we'll have to learn about in order to survive and make our career the longest possible, but also the most fruitful. And I think no one better than the society to keep you intellectually triggered, intellectually hungry to learn all these top skills and be a T-shaped skilled person or team. Sometimes within the team, you will decide to specialize in different different sciences or matters, and then keep the whole team relevant.
So I would just want to ask you the last question. What was one of the biggest learnings or lessons that you had so far in your career that you think remains timeless for no matter every young professional, everyone who's out there?
One only?
You can give as many as you want.
The first and the most important, never say I know. Never start your answers with I know.
True.
It makes you socially awkward, but it also makes you grow without any knowledge. You never know. Better to say you never know. Better to say I would like to know more. Tell me more about this. Stay intellectually hungry and challenged. You're as a human being, you're an empty bottle. You're brought to this world as an empty bottle. You're blessed if your family invests in you to fill the basics and the basis of the bottle, so then you don't tip on the side and fall with the latest blow of wind. And the more you grow learning, the more you're filling up the bottle. And when people knock on this bottle, they will not hear noise. So this is what I learned in life. I used to make lots of noise as a young person because the bottle was empty. And as I'm growing and being surrounded by smart people who keep on helping me go and educate myself, a network that helps me educate myself, because it's a life learning journey. So it's a life learning journey that fills the bottle. So then you never can say I'm full. You never can say I'm full, because there are always new technologies, there are new sciences coming, revolutionizing or changing the world you're in. So there's always some knowledge that's going to waste.
True.
Same like in any curriculum, you throw a lot to waste, but you have new formulas, you have new innovations. That's what keeps us alive. We dream and then we innovate and then we learn from that. So when people ask you a question, it doesn't make too much noise. You're straight to the point. You give them something meaningful to think about, and you change, hopefully, their lives.
True. Thank you so much. Thank you so much for taking the time.
Pleasure.
I'm sure so many people will learn so much. I have learned so much.